The results of a survey by the International Monetary Fund were released on October 3rd, showing that historically, in less than 60% of cases, inflation has fallen within 5 years. In particular, there were many cases where premature firing over the time to resolve inflation actually accelerating the inflation rate again. Contrary to Wall Street's expectations of a slowdown, inflation it continues to soar, and the U.S. Treasury bond yields support this claim. Recently, Fed Chairman Jerome Powell and other members of the Federal Reserve have continued to make comments suggesting the possibility of additional tightening, pouring cold water on the market's hopeful outlook. As seen in the IMF's report, the Fed is showing a strong will not to reverse past cases where hasty easing of tightening led to more serious inflation. Amid recent favorable economic indicators, the rapid rise in U.S. Treasury yields continues. Recently, the U.S. retail sales growth rate in September was 0.7%, which was significantly higher than the expert forecast, which served as a factor in pushing up interest rates. The increased financial burden on the United States due to the possibility of an escalation of the war between Israel and Palestine also added to concerns about the supply and demand of U.S. Treasury bonds. U.S. Federal Reserve Chairman Powell's remarks hinted that the current high interest rates situation could be prolonged. He hinted at the possibility of further interest rate hikes in the future if price stability must be achieved at the cost for the overall economy. As a result, interest rates on U.S. Treasury bonds rose significantly, and our stock market also plummeted. U.S. Treasury yields continued their upward trend, exceeding the 5% level for the first time since 2007. On October 19th local time, the 10-year maturity U.S. bond interest rate was 5.001%. It has been 16 years since July 2007, just before the global financial crisis, that the 10-year U.S. Treasury bonds interest rates rose above the 5% level. The rise in government bond yields began after remarks by U.S. Federal Reserve Chairman Jerome Powell, who assessed that the U.S. inflation rate is still high. U.S. Treasury yields continued to rise in July as expectation for soft landing for the U.S. economic growth. The fact that recent economic indicators continue to perform well beyond the expectations also had an impact. The Korean stock market also fluctuated as concerns grow about the prolonged tightening in the United States. Kospi fell below the 2,400 marks for the first time in about 7 months since March. The index increased each decline after opening at the 1,391.54, down 24.26 points from the previous day. The $1 exchange rate opened at 1,357 won, down 0.41 from the previous day, and fluctuated repeatedly. As U.S. Treasury yields rose, risk aversion increased. The interest rates on 10-year U.S. Treasury bonds exceeded 5% for the first time in 16 years. Geopolitical risks in the Middle East appears to be further heightened with Israel's deployment of ground troops in the Gaza Strip imminent. U.S. President Biden, who visited Israel, sought permission from Israel to import humanitarian aid in the Gaza Strip. However, with public opinion in the Middle East worsening due to the hospital disaster, the Middle East scheduled for Jordan meetings with leaders were cancelled. Iran has called on member states of the Warning Organization of Israel Corporations to impose sanctions on Israel and ban oil sales to Israel. Some foreign media reported that the possibility that the U.S. military may intervene in the war between Israel and Palestine Hamas following the drone attack on a U.S. military base in Iraq.